Hello to all of you and welcome, welcome, welcome. Let's get you all in the room. It's always fascinating. We've got people from all over the world, 178 countries. So I'm always fascinated as to where people are coming from. So if you live, chuck it in the chat room. It's always fascinating. If you watch it in the recording, obviously you are not able to do that in terms of the process. So I'm super excited. We've got one of our partners here, and Glenn and I are going to be taking you through a new investor launch in terms of Austin Business Finance, and we're going to be going into a bunch of detail around that. Just a quick disclaimer, and I think what is always important is that we're not giving you financial advice necessarily today. What's important for you is that we are trying to provide you with the right information so that you can make the right decisions for yourself, but always make sure that you do your own due diligence. I'm super grateful and excited to be introducing you to Glenn. Many people in our community have met Glenn. Glenn has done multiple presentations, including one that I'm super grateful for, where he actually taught our mastermind clients the whole asset class of private equity and why it is so important that you've got a component of private equity in your portfolio overall. Now, today's not about the mastermind. However, Glenn and his partner, Selwyn, started and run Caleo Private Equity. And what's important here is that I know no one ever likes to talk about themselves, Glenn, so I'm going to do a little bit of it for you, and then I'll hand to you just to talk about Caleo Private Equity. But between yourself and Selwyn, you guys have extensive experience. If you read through here, over 20 years of experience investing and fundraising globally, ultimately in the institutional space. This is really important. He's a chartered accountant by background. His business partner, Selwyn, is a PhD. By the way, as I always joke, but from Cambridge, and also CFA. So both very much in the financial space, both very much in the institutional space, and most of their careers in the private equity space. So before I go any further, Glenn, it's always really important as to who the partner is. I always say with people think they're investing in deals or property or whatever it is, private equity, but a lot of it comes down to the partner before you even get started. So tell us just a little bit about Caleo Private Equity, yourself and Selwyn. I know you guys have a long-standing relationship of not only the ups, but also the downs and going through market crashes and how you behave. Just talk to me a little bit about Caleo Private Equity, if you don't mind, and to some extent the ethos of Caleo Private Equity, because I think it's really important.
Yeah, thanks, Scott. So, a little bit of background on how we came about and why we came about. Selwyn and I actually go back into R&B days, ran Merchant Bank, and we ran one or two different businesses in R&B. I'm talking 10, 15 years ago. And through that experience, we got a lot of private equity experience, real estate investment experience, fund management, real estate development experience in Africa. And I guess it's a little bit of a journey that you go through in terms of going into corporate, experiencing and getting very good experience out of that. And then ultimately, I think I finally made the decision, look, I want to actually do something which kind of aligns more with my thinking and my view on how businesses or how private equity should be run. And that was really the beginning of Caleo Private Equity. And Caleo Private Equity commenced probably 5-6 years ago already. I was lucky enough to meet the Caleo Capital guys, and Caleo Capital is a wealth management company. And through them, we started building the business around offering private equity investment to high net worth individuals and private people as well, because the reality of a lot of private equity is actually not accessible by most individuals. And I think we found that through this, we could offer that to the individuals and give them that access. And the other thing I felt quite strongly about is...
Can I just stop you there very quickly? Because I just want to kind of interlude to what you're saying. Private equity is a part of the market that the wealthiest people invest in. And what Glenn's pretty much saying is that's where the institutionals are played. Again, today's not about teaching people about private equity or even the debt markets, but it's where the sophisticated institutional players are investing. And generally, the high net worths, even often the ultra high net worths, but certainly not the retail investors, have any access to that opportunity. And that's what Glenn's just referring to. It's a segment or sector of the market that most people didn't have access to unless they were an institutional player.
Correct. Exactly correct, Scott. So I think the other part of what I really wanted to achieve with the business, and I started in a year in, I actually got hold of Selwyn, called him up, and I said, listen, we need some extra hands on deck. I need a partner in this business, and Selwyn joined me. But in terms of how we approach private equity, for us, there's a few fundamental things that are quite important. We call ourselves conscious investors. I think and everyone has, some people talk about impact investments and some, everyone has their own rationale for why they invest. But from our perspective, we call it conscious investment because we'd like to look for businesses where we believe they make a difference, either in terms of adding jobs or they're green in some way or that for that matter. And the other thing that's crucial to us is relationships and people. I think the important aspect of private equity is if you know the people and you get to know them and you can trust them, then a lot of the business decision around whether you do or don't invest in a business is actually made for you. Because if you get the right individuals behind a business, they're very well equipped to, and I don't like this word, but it is appropriate. They're well equipped to pivot. If an environment changes or landscape changes or whatever, they're generally very quick to move in a different direction to ensure that the business remains sustainable. And then the final thing, which was crucial to us, is actually to do a deal by deal type of investment. Generally, the way private equity works is it's a fund you raise, you go out and you say, okay, I'm a fund manager, I'm going to raise 200 million or 3, 4, whatever it is. And your investors come in and they don't really get direct exposure to the underlying investments. And that can be good if you just want to sit back and let the manager do their thing. But from our perspective, we found that individuals certain of them aligned to different types of businesses, different types of people, or different industries that they personally were passionate about. So I think through that we said let's actually go down the route of a deal by deal basis where we actually find a specific investment and then we show it to our investor base, and certain investors will say, you know what, that makes sense for me, or you know what, that's not my cup of tea. So that's really a little bit of the background behind why we exist and how we exist. If you look at, and I don't know, Scott, if you want me to dive into Austin Business Finance a little bit.
I want to just before you go there, because I do have a caveat or a pivot that'll take us directly in there. So if you look here, I've literally got your website open, and you basically talk about communities are more powerful than networks. At Caleo Private Equity, we aim to build and grow community through investment and advisory activities. We bring together like-minded individuals and companies that exchange resources and advance ideas, deepening and solidifying the relationship of trust. And I just it's time now to hand to you, because you've got a really exciting opportunity that you guys have been working on, and as I understand, investing for many years now, and also put significant of your own capital in, plus your high net worth family office clients. And I'm super excited to have the opportunity to share it with our community and our investors to be able to participate alongside you. So, this is that moment, Glenn, where I'm like, tell us all about it and how are you guys been making money? I know that we've got investors that are with you already that are really, what's the right word? That like the predictability of the income. And so I'd like to obviously share with others how if you're wanting predictable income, then this is something that is working for other investors, and we wanted to make it available to you.
Correct. So I think I'll probably, it's easiest to bring up a presentation here. I'm just going to share the screen. Just let me know if you can see that.
Yeah, I'm seeing it. Yeah,
showing up.
We got you loud and
yeah. So the business opportunity is a company that is actually called Austin Business Finance in the US, obviously based in Austin, Texas. They trade as backed, so you'll see it says backed here. And really, the story behind backed actually started about 5, 6, probably longer, 6 years ago, when we were looking at opportunities in South Africa, and just so your clients and your investors are aware, we invest as a business both locally in South Africa and offshore. So ironically, this business was actually an offshore business, started because we were looking at a business in South Africa called Cashflow Capital. And Cashflow Capital really, what they were doing is they were lending to basically franchisees. KFC, for example, Steers, those kind of guys. And they found that those businesses didn't necessarily have a big asset base, so the banks weren't that keen to invest into them. But if they found the right type of operator who had two or three franchise stores, it was quite easy to lend to them, knowing that they had a very predictable cash flow. Hence the name Cash Flow Capital. So I got talking to the CEO of Cashflow Capital, a guy by the name of Zahn Myberg. And it became very clear that Zahn had ambition to actually launch a similar type of business in the US. And through that we said, fair enough, we'll actually excuse the phrase, backed in the US. And we, as a business and as a private equity outfit, we injected $14.5 million into that business. And we're talking 5 years ago. And they started a very similar type of business in the US. And there were obviously a few lessons learned. Funny thing about South Africa is it's very easy to speak to people. You can walk into a franchise store, you can walk into a Steers, you can speak to the manager will know the owner, you can speak to the owner. Very quickly we realized you can't necessarily do that in the US. The US works very differently. And there were a few lessons learned along the way about how you do business. But ultimately, and the business expanded, and ultimately the way that Backner now works is it makes medium to short-term loans to SMEs in the US. And I'll give you a little bit of, I'm just going to page down here. I don't know why it's not actually paging down. There we go. Yeah, so there's a lot of words in front of you. A lot of it I'm talking to. So I'm not going to go into too much detail. This talks about how we got involved in it. I think what's important in terms of this investment opportunity is we call this private debt. So although as a private equity business, we invested into the equity and started this business 5 years ago, we have continued to support the business through providing it with additional capital. And that capital has always come through a mechanism which we call private debt. Very simply, investors have invested into the business. Basically, they make a loan into the business, and in return, they receive interest on a monthly basis. And that loan is effectively in the business for 3 years. It can roll longer if you wanted to, or otherwise you just give notice on your loan and you receive your capital back. So it literally is that simple. So that slide really talks to that. What is the business? This really talks to the opportunity in the US. When we first got involved in the US, the question that investors were asking us is, why do you think you can go to America and compete? And this slide kind of talks to that. If you look on the left, you'll see that there's effectively 30 million small businesses in the US. And the interesting thing about businesses in the US is a lot of these businesses don't have access to borrowing. They can't go to a bank. The banks won't lend to them. So ultimately, that's what. And the reason that a lot of them won't lend is because traditional banks typically lend on the back of assets. So they go to a business, say, "Oh, you've got assets, fine, I'll lend you some capital." What Zahn and his team wanted to replicate is the model that we had in South Africa, which was effectively lending on the basis of strong operational cash flow. And as I said, the reality is they could compete because, first of all, the banks and the financial institutions weren't doing this type of lending, or not on a large scale. And secondly, the number of opportunities in terms of the number of businesses that existed for this was quite exceptional. I mean, 30 million small businesses is quite something. So really what this talks to is the fact that Cashflow Capital had its own, or Austin Business Finance has its own credit technology, which they could use, which would assess how good a business is, its ability to repay. And ultimately, they were using that technology in the US, approaching businesses and effectively making loans. This slide, once again, just talks to how, the competitive advantages that I've mentioned. They're very transparent. All the costs in terms of the lending were upfront. The technology that they have, I think, is very important to mention. Effectively, they can turn around a loan within 24 hours. So a business needs money. If they have the right information from that business, they can literally run it through their systems, and then it runs into effectively a committee, and the committee makes a decision whether or not to make the loan or not. So very, very quick. I'm sure you can access these slides at a later stage, so I don't want to bore you with the detail, but I'm always happy to touch on it later. One of these slides, once again, online application processes.
We'll put them in the resources page, Glenn. So I'll put them up.
Okay,
I'll show people a little bit around how to find that online.
Yeah. Okay, perfect. Because that talks to the credit model. This slide, I think, is obviously based on how the business is done and its performance. I think this is probably the most crucial question that an investor would want to know is like, how risky is the business? You can clearly see, I mean, the slides that I've got here are dating back to 2021. And this really shows the different type of metrics we use to measure a debt-based business like this. So you can see very strong gross profit over time. The advanced receivables book, which is the one on the right, that's quite important to understand that. So that means the business is, you can see a very good trend there. Basically, the business is growing continually. It's lending out more capital. We, as Caleo Private Equity, were the first ones to obviously put capital into the business. But I think a big feather in the cap of this business is they subsequently raised in excess of $50 million from an outfit in the US called Fortress. So they clearly have a much bigger ability now to continue to grow the business over time. So Fortress provides them with a certain amount of debt. It's a very secure type of debt. But in parallel, we continue to provide them with our own debt as well. And ours is a rolling debt. So whenever an investor wants to invest into the business, they call, we speak to them and they say, okay, I would like to put some money in, and we can effectively use this instrument that we're talking about here to do that. So very comfortable with the business. It's a lending business. So the question would be, well, when you lend, not everyone pays you back. What's the default rate in this business? It runs at about 5% default rate. So to give you an idea, it's generating in excess of 20% per annum on the capital that it lends out. But it's effectively runs a default rate of 5%. That is extremely low for a business such as this. And that talks a lot to the quality of the credit control systems in place, the scoring systems, and the manner in which the loans are made. I think probably one of the statistics that really astounds me is, just to give you an idea, BACT basically received, I think in the month of July, they received over 8,000 applications alone, 8,000. And they only did 56 deals. So out of the 8,000 applications, only 56 businesses received a loan from them. So you can see they can clearly, obviously, the word cherry pick. They can clearly cherry pick the loans they want, the better quality loans, and that leads to a lower default rate. The other thing that would lead to a lower default rate is just the size of the loans. So they tend to average around about $250,000 on average to a business. If you look at the size of the total book, the total amount that's lent out, it's around about 80. I think they've lent to date around about $80 million for the year, just for this year. So when you're lending out at $250,000 a pop, you definitely have very good diversification in the business. This slide, very simple, just talks to what is the instrument, where is it based, how does it work? Effectively, it's a direct debt. As I said, it's private debt, so it's a direct loan that you make into the business. The business is based, it's effectively called Austin Business Finance LLC. We as the manager, we're on here. We obviously very involved in the business. We speak to the CEO and the management team probably I'd say at least once, if not twice a week. The type of instrument you would be investing into has the minimum 3-year period. I mentioned that earlier. We've dropped down our minimum investment in this down to around $50,000. That Scott I'm sure he might elaborate on that. Generally, we would normally target around about $250,000 per investor. And then the rates that you would be offered here can vary depending on the amount of money that you're investing. So it can be easily up to 10% on your money. And that's 10% in hard currency. So obviously that is quite attractive to a lot of investors. Yeah, and that's kind of the high level. Scott, I don't know, I'm more than happy to dive deeper, or you know,
Yes,
you tell me how you would
no,
take
so
it forward.
I think a couple of things here, Glenn, that are firstly important. The first one is there's two stories that I like around what you've said. And again, I've been with yourself and Selwyn. We've talked about this investment opportunity a couple of times. So the one is the way they behaved during COVID, which I think is quite important. So there's a debt instrument. So what I'm trying to go to is that in any investment, people should be looking at risk. And when it comes down to risk, I always say there's only two things you need to look at: the right information and the right partners. And one of the things that I enjoy under the COVID time was that everyone was kind of looking for angles and dispensations and whatever. And as I understand it, you guys even went to the partner and said, look, investors would understand if they had to put interest payments on hold. And I'd love you just to tell that story because it shows a lot of the metal of the caliber you're talking to. Because again, for me, when you invest with a partner, it's how they behave when it's not working that's actually relevant.
Yeah, so that's a great question. Yeah, so obviously Austin Business Finance had been operating for, I think at the time, a year and a half, 2 years, really getting off its feet and kind of trying to establish itself in the market. And there are other lenders out there, one or two listed ones actually, that kind of do similar type of business. Just to be very clear, Austin Business is not the only one, but they were much bigger players, and COVID hit. And yeah, I mean, we had to have some very immediately conference calls. How are we going to handle this? What are we going to do? And Zon, the CEO, turned around to us and he said, no, I'm going to carry on. I'm going to actually continue to lend because my competitors are actually backing off. And the irony is there are businesses out there that desperately need the money. And so for us that was quite something. And we were like, well, but aren't you concerned about the quality of the businesses, even on the ones that you've got on your book? And the truth is, I think because of the quality of who the businesses they'd lend to, as well as the fact that they were well diversified, the default rate hardly moved. So Zahn's idea of continuing to push forward with growth and lend out was in hindsight a great one. And also what the decision they made, which was also reasonably smart, is they said, well, let's focus on service-based businesses. I recall very well how they suddenly started making loans to companies that were providing medical assistance, cleaning services in New York, for example, all sorts of services that were still required within a COVID environment. Those type of businesses were still looking for funding, and ultimately, we came out of that after 2 years, and Austin Business had more than doubled the size of its business, and the default rate hadn't changed. So yeah, it's a great story, and I think the reason that's important is I talk about the default rate. There's a point where your money would get impacted. We've looked at this very carefully. So the reality is, for example, if you're lending into this business through this instrument, your capital's only really at risk when the business hits a default rate of around about 12, in excess of 12%. So it runs at 5%. It ran at 5% through COVID. To imagine it doubling to 10 is, I mean, I'm touching a lot of wood now, but really, that would be quite. I mean, we'd have to see some sort of. I think we're going to have all that bigger problems in the world if that's happening. So the reality is, you get a lot of comfort by the fact that they're running a very solid credit-based lending business with a reasonably low default rate. And that can continue because the market is large. It's not like they have to change their lending style or lend to higher risk type of businesses.
Yeah. Look, my second point, and you've already made it, but I just want to illustrate it, is that I always say to people, when you're investing with a partner, there's three primary things you need to look for. One is, have they been in business in this sector for more than 10 years? You've already mentioned not only yourselves in terms of the private equity space in general, but also your partners on the ground. I mean, this is what they specialize in. So we can tick that box. Secondly, are they niche focused? Are they trying to just lend and do it to everyone? No, they're not. They've got a specific niche. And what's really interesting in that small to medium business enterprise in America, not only because of this business, I actually know two other operators that are playing in the space. It's a booming business. Like there's a massive demand as the banks are not providing for this sector. This private debt is one of the fastest growing sectors in this market. So you've got the tailwinds behind you in terms of growth, but obviously you've got to have the right partners, because I couldn't go in and suddenly start lending to businesses. It's not my skill set, in terms of that process. And the third one, which is as important, if not more important than all of them, is, do people have their own money in the business, and is it treated equally? And to my knowledge, Glenn, between yourself and your investors, you guys have somewhere in the region of $14 to $20 million between debt and equity, sitting alongside
in excess of 20 million.
In excess of 20 million. And I think that's quite significant. So if someone's putting in $250,000, it's to know that, well, the people that you're talking to have put in, $20 million plus. And, and I think that's quite an important, understanding for everyone. So those are three things that I think are very relevant. And so if you take it at a macro level, you've got the opportunity to say, okay, well, is America going to continue to be a powerhouse, economically? And I think, everyone can talk about what's happening in politics and whatever, but let's not get caught up in the news cycle. At the end of the day, middle class America, that small to medium size entrepreneurial environment in America, I don't think it's going anywhere far, anywhere in a hurry. So there's always going to be demand in that sector. You've got a good solid partner on the ground in terms of being able to invest. And then the last part is, well, how do you actually access it in terms of the opportunity? And I think what I just wanted to share with people here was that, the slide that I like to share with people is, you can go and do this all yourself. Glenn said to you, look, there's a good opportunity in America in the private debt market, specifically in the small to medium enterprise businesses. As I say, I know personally 3 people that are in the sector, and all 3 of their businesses are doing really well. So you can go and do all of this work, due diligence, lawyers, tax, structuring, banks, setting it all up, KYC, AML, or you can literally look at 4 simple steps. You can sign up on our platform, you can set up your account, you can browse and invest, and you can finally earn an income in terms of the process. People say to us, well, how does the money flow actually work? Well, you're sitting here and it's your investment account. You invest your money into your digital wallet. So we set this up with our partner in Europe, from Lemonway. They're the biggest digital wallet provider in Europe with over 8 million wallets. So each one of us, have our own personal investor wallet. We then go on the digital marketplace, somewhere like Migrate, and we take an opportunity like this one, so the Austin Business Finance opportunity, and ultimately as investors, we aggregate it. So as Glenn said, they traditionally only worked with people with $250,000 and up. And what this allows using technology is to bring the investors together. So we come along to someone like Glenn, we put it into a special purpose vehicle, which is tax efficient, and ultimately we take ownership of our position. Once that distribution is paid, and to my knowledge, Glenn, the distribution is actually paid monthly. Is that correct?
That's correct. Yeah. That is.
I mean, again, I know that the business is paying monthly. We often tend to do our distributions quarterly, just because we actually want to maximize investor returns and we don't want to be watered down by bank transfer fees and international banking and all that. But anyway, the bottom line is an absolute minimum. It's quarterly, if not monthly. It goes into a deal wallet and it gets paid back to the investors. So what people really like here is the ability to get passive income in terms of that process. And I know there was one lady that joined our mastermind, and she really wanted to get a passive income. She met with the Caleo Capital team. They helped her invest in this opportunity because it wasn't on our platform yet. She invested, and within a month, she was already earning a passive income. And that's quite substantial for people, as you say, in a hard currency to be earning 9 or 10%. And in terms of the process, and then ultimately investors can put that back into their investor wallet, and they can do, into their bank account. They can do whatever they want. They can reinvest in new deals. They can go to Disney World on holiday, whatever it is. So ultimately, investors have, four simple steps that they can look at. They can go to the Migrate platform. They can literally sign up, complete their profile, fund their wallet, and invest in an opportunity like this in terms of the process. And then for those that are part of the mastermind, by invite only, we've got access to Private Wealth Global, which is an exclusive opportunity where we only do the Caleo Private Equity deals there. So it's their due diligence. There is a discount on fees. There's a minimum investment of $50,000, as Glenn has already alluded to, in terms of that process, and there's a private banking service. And then the final question that people say is, how are my funds protected? The first one is that you've got external cash custody. So we work with Lemonway. It's European compliance, European regulation. Secondly, you've got discretionary portfolio manager from a governance perspective. Thirdly, you've got designated investor accounts. Fourthly, you've got ring-fence deals. So as Glenn's actually alluded, this is not a private equity fund where you're investing in multiple things. You're investing in this specific deal. You know what you're getting involved in. You've got designated corporate members. You've got external custody of investments. And finally, you've got operational and investor segmentation. So for me, these are really important in terms of the overall way to look at it. I've done this for 20 plus years. And what's important is looking at what doesn't work and making sure that you've got the safeguards and the balances on top of everything we've already discussed in terms of that process. So that's, if anyone's got any questions, you can literally go along to invest@wealthmigrate.com or speak to one of the team in terms of the process. What I wanted to do, Glenn, in terms of summation from your perspective, and there's a couple of questions that have come through, is that the thing I like about this opportunity is it's what I call an evergreen opportunity. So what I mean by that is that if we're buying a building, I mean, we did a highly successful deal with you in Manhattan at the end of last year, but that was a fixed building. There was an opportunity. You got in when the money was raised, and that's it. And those that got in, well done to you. I was part of them, and those that didn't, well, toughies for you, But the nice thing about this opportunity is that there's always going to be businesses in America that need to be funded. And to what I heard you say now, let's say it's 5 a month on average. So there's always going to be capital that's being rolled over and invested, etc. And so our intention with Caleo Private Equity is to do this on a tranche basis where people can invest. We close a tranche, we invest, we invest, we get the returns, and we're doing tranche after tranche after tranche. So whether people are watching this video and it's tranche 1 or it's tranche 22 is actually irrelevant, because people will have the ability to participate ongoing. Just talk to us a little bit about that, because I know you guys have effectively been doing this, to my knowledge, for roughly 5 years, and we're just kind of joining along on the wagon,
Yeah, so that's correct. We constantly injecting capital into the business through the senior debt. I think the interesting point here is it's a fixed rate. So I think that's quite attractive to a lot of investors and clients, because ultimately, rates can go down. In fact, if you, I'm sure you know all about this and you've talked about it. The talk in the US at the moment is that rates will start dropping very soon. So you get to lock in an attractive rate right now, and you're locked in for 3 years at that rate. So that's the good part. The truth is, the way we've negotiated it with the company is that we always have an open door to continue to provide them with debt. The reality is, as the business grows, and it's growing at a good rate. So as the business grows, it becomes a much stronger business. It can attract cheaper debt. I mean, that's the reality of doing good business. And ultimately, I think that the only thing that may change over time is if they're getting more competitive price debt elsewhere, we would have to compete. At the end of the day, the business wants the cheapest funding it can find. So you definitely, if you invest today, you're going to get your 10% for 3 years. If you invest in 2 years' time, it may not be the 10%. It may be slightly lower. But generally,
Well, I mean, just as a caveat there, Glenn, I was actually going to say that, whatever you're hearing on this video, please go below on the platform, use the calculator in terms of the returns and everything else, because hypothetically, let's say interest rates have dropped by 4%. I'm being facetious, but you get my point. It might have impacted the rates, and everything will always be updated in real time based on what people are investing in. Our 3 core values are trust, transparency, and alignment. So it's very important from a transparency perspective that people know exactly what they're getting involved in, what the returns are, when their income distributions are, and what their exit is.
Yeah, perfect.
Could I ask a question here? It's from Hans, and Hans is out of Europe, and he's asking, if it's already mentioned, could you please clarify what the borrower credit rating is? Additionally, I'd be interested to know what the margin or cost is for the borrower in this case. And he went on to say, just to avoid misunderstandings, we may use different terms in Europe. This is senior debt, meaning it takes priority over other forms of debt, correct?
Okay, so let me start with the first one. The borrower doesn't have a credit rating as such. There's been no real need to do that. Generally you would find if they're going out into the high yield market and they want to actually price for bonds, or potentially, I imagine certain banks may want a credit rating. Then we would probably go out and get a credit rating for the business. So right now, just based on the size, number one, of the business, there's no need for a credit rating. And number two, based on the fact that they have very open lines to what I mentioned earlier, which is Fortress as a lender. Fortress is a very large private debt provider in the US, and Fortress haven't requested them to get a credit rating, and neither have we, because the truth is we manage and monitor this business on a monthly basis. We're very comfortable with the credit quality of the business. As mentioned, I know, Hans, I think you said that you jumped on a little late. So you might not have heard, but we got involved in the business over 5 years ago, originally from a pure private equity position, which is basically taking equity risk. And then we've transitioned now into just providing senior debt. So, from a quality perspective, and that's what I was showing in some of those graphs earlier, the business has continued to improve in terms of its credit quality. Your second one was you'd interested to know the margin of the or the cost. So a little bit of that's probably a little bit of a competitive data, which I'm not sure I can provide too much on. I think what I can tell you is if you look at the average cost of funding, I would say it's coming in at around about 10%, somewhere there. It varies because remember there's Fortress funding, and that's cheaper than ours. Our funding is a bit more expensive. We also have funding that we did earlier on, which is a little bit more expensive than that. So there's different forms of debt in the business, but on average, I'd say the weighted average cost of funding is probably around 10%. And then you can work it out. If you look at what the business does and how it lends, it's doing, I said in excess of 20%. It's more north of, it's around about 25% on average per annum in terms of its interest margin. And the reason that margin is so high, it's not because they're charging one client 25% for a year. It's because the nature of the funding, which is reasonably short term, means that it rolls quite quickly. And because it rolls, you get that exponential effect on that interest rate. So you can kind of use that as a rough idea, to 25 versus 10. I think that would give you an answer. And then to talk to the I like your question on, what is senior debt? Where does it sit in the capital stack? Like how senior is it? There's actually four types of capital in this business at the moment. There's secured senior, I'll call it senior secured debt. So senior secured is the Fortress capital. The Fortress capital is in excess of 40 million in the business at the moment. And that's secured against the debtors. So they have first priority. Then you get the senior debt, which is this debt we're talking about. So it's not secured, it's just senior. And the reason it's called senior is because it's senior to the other two forms of capital, the one being pref share capital, which is equity-like, and then pure equity. So that'll give you some gauge of where they sit. And that's why I was saying, if you look at where this sits within the business in terms of what would happen if default rate increased. That's why I was saying they run at a 5% default rate. If they had to move to 10%, even 12%, you would not expect this debt to be impacted.
Awesome. Thank you. And I love what you said around the institutional piece. I always talk a lot about how, again, in the old days, and I included, people's kind of mindset was try and control everything, do it all oneself. And now I find it much better to be a sucker fish on a whale, where you're investing alongside, massive institutions that have a lot more ability than, from a due diligence and all that other stuff. And that's, for me, Glenn, not only are we being able to partner with Caleo Private Equity and Caleo Capital that have put in $20 million plus, but you've got Fortress that are putting in, I think what did you say, $50 million lines of credit? And I know it's a hell of a lot more.
Yeah, the line of credit goes up to around about 80 million, but
Yeah.
right now I think the book is on the Fortress is somewhere around about 45.
Yeah, which again, it's significant capital. So I just want to show people it's on the platform. It's currently under review, and as soon as it goes live, so whenever we launch something new, we've just got to finalize the payment pathways with Lemonway and how the flow of funds work. And unfortunately, this is the part of the business I don't like, which is the KYC, KYB regulation. But it's good to know you're playing in a regulated space. So that's all there in terms of it. So it'll be up and running as soon as those compliance officers tick those boxes. And yeah, Glenn, I think from my side to summarize, and something that from your guys' perspective, I know this has been a bit of a baby for you, and what I mean by a baby is that it's been an exciting project, certainly for the last couple of years, 5 years or so for you. And if I was to ask you your kind of elevator pitch, why is this something that excites you as for yourself in terms of from an investment perspective, just in a nutshell, to summarize?
Gee, you would think that would be an easy question. So you've kind of touched on it a little bit. It was one of the earlier businesses we got involved in, but I would actually say that it talks to what I mentioned right in the beginning, is around backing the right people, the right business team, and ultimately, yes, they originally were in South Africa, and I know Zon. I've got to know Zon very well. I got to know him very well before he moved to the US. But that really talks to knowing your management team, knowing the execs, knowing what they're about, knowing that there's a very good element of trust. So after 5 years with this business, we're very comfortable. It sits very well with how they operate and how they do business, and also how we're involved. Caleo Private Equity, we tend to take, I would say, minority stakes in businesses because we feel quite strongly that the owners or the entrepreneurs or the founders need to be empowered to kind of run their own business. And our role is not to try and run their business. Our role is to sit as a support system, a capital provider, to jump in when there's a crisis, and obviously to help the business strategically. So I think for me, that has been a great journey with these guys, and ultimately they are ambitious, and they want to build this business, and yeah, I mean, that's exciting for us. We can we've seen a good, strong history here. So that's really it.
Awesome. Just, I don't know if you can talk to this, and you have sort of mentioned names already, but Gustav asked any details on the ownership of Backed.
Yeah, I mean, obviously it's a private company. I can kind of give you a high level. Caleo, together with our investor base, own around about 40% odd of the business. The management team, they would say they own around about 35% of the business, and the rest is owned by high net worth individuals and early seed investors.
Excellent. Hans has got a question here. In Europe, it's mandatory for a bank to assign a rating, and if you do it yourself, I'm sure you would have your own system. How would you rate your borrowers? The reason I'm asking is if I can assess the return, if I understand the risk. It's currently easy to achieve 14% per annum if you take on more risk. So I'm trying to put this info into perspective. Are these borrowers more like A or B clients, hopefully not C? Could you perhaps provide some insight into this? Thanks very much. Just quickly, before you go there, Glenn, I just want to repeat what you said along the lines of, I mean, did I hear you correctly where you said, no, I think I must have misheard you. Like there was something like 8,000 applications, or what did you say? Like and they only funded 5, or what was it in terms of where you said they can pick and choose? I can't remember exactly how many it was. It was a hell of a lot.
So for the month of July, and this happens every month. I mean, for the month of July, they received 8,000 applications from businesses, and they funded 56 of them. So, ironically, when we first started, the applications were like 300 a month or 400 a month, and we were doing three. But yeah, so the quality of the borrowers, they're very, very selective in terms of who they lend to. They aren't rated. If you said to me, are they A-rated clients? No, they're not. I would say, you mentioned, Hans, you mentioned like, are they A, B, C? I would say, I don't know how well you know the US high yield credit rating system, but having been involved in US high yield some time ago, you get your like A, B rated. Obviously, I mean, we're talking, you would have to say US credit is A rated. JP Morgan is probably triple A, somewhere there. And then you get the triple B, which is still investment grade. I would say they're probably a double B plus if you know your credit scores. And I think I would say that's kind of middle of the road in terms of the type of businesses in the US. So if I look at, sorry, I'm just going to look at yours. You said A, B clients, hopefully not C. I would say it's B clients. A clients are going to be your very large businesses that are going to go to banks and borrow from banks and do that. So I would say it's the tier below that either don't like the pricing from the bank or aren't getting pricing from the bank because they don't have the assets to secure the borrowing against. The one thing you can look up is, if you want a little bit more understanding of it, if you go online, I think it's called a FICO score. And basically these guys, bear in mind that there's credit models in Austin Business Finance. So a lot of the credit rating is done internally on the quality of the business. So they obviously have their own internal rating system on whether or not to lend to a specific business. But if you look at those FICO scores, I think, if I recall, they only focus on a score of 600 or more. And that will give you some idea.
Awesome. Well, Glenn, I deeply appreciate your time. Thank you to everyone. Thanks for the great questions as well. Always awesome when the community is involved in asking questions. And just to remind anyone that, you can go online, you can take and use the platform to invest. And or if you've got any questions, you've got invest@wealthmigrate.com, or jump on one of the community chat rooms and be able to chat to us, etc., in terms of the process. But Glenn, as always, it's an honor and a privilege to be able to partner with you, to be able to invest alongside you. And I deeply appreciate the opportunity for investors, be they retail, high net worth, ultra high net worth, or even institutional, to partner alongside you and to take advantage of an opportunity that previously wasn't available to people. And again, this is not a new opportunity. It might be new for us, but it's not new in terms of everyone else investing. And I personally know people that are invested. I know quite a few actually, and are getting their returns and everything else, which is why we pushed hard to allow people to be able to participate through the platform. So I deeply appreciate the opportunity. Thank you very much.
No, Scott, thank you. And thanks to your investors for the time.
Awesome.
Always good chatting.
Keep well, everyone. Cheers.
Thanks, everyone.